Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, European rate strategist, and I'm joined today by our global market specialists, Giles Gale, Theo Chapsalis, and Jan Nevruzi. Before we get into today's discussion, I'm very excited to say that Bondcast has now hit the big time and has its very own channel. So if you want to keep getting the latest episodes of Bondcast straight to your ears, head over to Apple Podcasts, Spotify, or wherever you get your podcasts, search for Bondcast, the Rates Podcast, and hit subscribe. All right. So another really volatile week. I'm going to have to start with you again, Theo, because it's really been UK rates that have been driving the volatility. I think, well, you can give me the exact quantification, but I would say that it's some of the most volatile moves that we've ever really seen in the UK rates market. So perhaps you can just give us your take on what's been going on.
Yeah, absolutely. So definitely what we've seen this week, it's volatile conditions that compare only maybe to the COVID period in March 2020, when we really saw, the market being extremely, extremely nervous. Now, what stands out is that this has not happened because of a pandemic or because of, surprises that are too negative. That has happened because of a market that tries to find its footing, tries to understand, to interpret BOE's reaction function, and this is becoming increasingly difficult. So to give you an idea and to put things into context, front-end SONIA rates sold off by almost 30 basis points on Monday. And today, these same rates are rallying by around 10 basis points without much additional information. In fact, the inflation data that we received today, and we're recording that on Wednesday, the 20th of October, the inflation data that we received did point to really strong inflation. So if something, it should support higher front-end rates. Long story short, this volatility is really triggered by the very front end of the curve. We talk about extreme volatility that feeds through to the rest of the curve. It has to price in the rest, what is going on at the front end, and it has implications for the market, but also it has implications for other markets. So this huge degree of volatility is made in the UK indeed.
So you mentioned there, I guess, it's really the front end that's driving the curve. And obviously what we have seen is a huge shift in market pricing for rate hikes. We've now got 100% of a rate hike price in the UK by the end of the year. Do you agree with that? Or do you think that rate hikes come later?
So we think that a lot of optimism is in the price. We find that the market rushes to price in those hikes. What is interesting is that the BOE, they've not pushed back at all. There have been some comments from a few members, for example, Catherine Mann, that can wait. She said that she can wait, for example. But Bailey pretty much saw this repricing, and over the weekend, he wanted to make it clearer. He wanted to give an additional signal. So he was very explicit that, rate hikes are coming. So it may be the case that indeed rate hikes come sooner rather than otherwise, but not necessarily to such a degree, because we need to take into consideration that once we reach the 0.5%, gilts will not be reinvested, 1 point, and then once we reach the 1% threshold, we may talk about a balance sheet reduction and active selling of gilts. And those two measures are actually measures of tightening. So they will translate into higher yields at the back end of the curve when they happen. So we need to be careful of the degree of tightening that we want to signal. So to us, as things stand, we think that the market prices in at the front end too high rates. What we think, though, is that the amount of volatility is particularly high. This is why deliberately we do not have any trades there, because by the moment that somebody puts a trade on or puts a view on, they may reach either their target or be stopped out because of that volatile behavior. So this is why we look at opportunities in other parts of the curve and in other sectors where we think that there is a lot more value.
Now, just moving away from monetary policy slightly, and I will come back to it because it's obviously very, very relevant for European and US markets. Like you say, the UK is causing a lot of volatility elsewhere too. But just while I still have you, Theo, obviously next week we get the updated budget. Can you quickly run through what your expectations are for that?
Yeah, I think this is a very important moment for the UK because it may very well signal a shift out of the mantra of spending whatever it takes. So the UK in the post-COVID era, or at least, after the onset of the pandemic, was very keen to spend. And we're used to seeing high issuance numbers. But what we expect to see next week is quite a different budget. So first of all, tax receipts have been running faster than expectations. Second, spending has been slower. We also know that 12 billion will be raised through tax increases. Now, if we take all those points together, we find that some of the needs to raise cash, so that number in the UK, which is called CGNCR, which pretty much is the cash that is needed by the government. So that number pretty much may be a lot lower than what the market believes it is. And we price in 165 billion of that CGNCR number, which is particularly low. What does it mean for the gilt market is a lot less issuance. So we talk about 42 billion of less gilts to be issued, which in our view is quite significant. And we talk also about a market where investors will need to reassess the views that they have with regards to gilts and the availability that they find in the gilt market. Long story short, some of those gilts may be more difficult to be found. The budget will be important, will be significant. So we think that, gilts may be close to their cheapest point now.
Well, that kind of already answers my next question, but I was just going to ask what that, your views on the budget really imply for the market and perhaps cross-market themes that you're looking at the moment as well.
Yeah, I mean, there are two different themes that we find particularly pertinent. One is the cross-market that you mentioned, and this is where we do have very strong views. And the view that we have is that we really think that gilts are a cheap asset class relative to others, relative to treasuries, relative to bonds. The Euro team, you guys are a lot more rates bearish. In the US side, it's a little bit more nuanced. But gilts, we think that they are at a very, very cheap moment. And in a world where inflation is particularly high, it is difficult to go outright long a market. So we think that gilts offer value from a cross-market point of view relative to bonds and treasuries. So this is one thing that we like. Another thing that we like and we think that will pan out is really inflation expectations at the back end of the UK curve should widen, because linkers is really an asset class that we think will be in scarcity. So there are specific technicalities, coupon money, index extensions, those flows will support the market. De-risking activity is another one. So there are solid arguments why linkers will perform. But once again, we like a view in terms of break-even simply because it is really difficult taking an outer directional view with regards to fixed income.
All right, thank you, Theo. So over to you then, Giles. I guess for you this week, I have, sort of similar questions to what I asked Theo. Obviously the UK has been driving the kind of volatility in markets, but it has taken Europe with it. And rate hike pricing in the Euro area has shifted quite significantly, just over the last week as well, but I guess generally speaking over the last kind of 6 weeks. What's your take on that? Do you agree with where the market's priced now, or do you think it's gone too far?
No, I don't agree at all. I think it's definitely gone too far. I mean, it's not. No, I mean, it's never impossible, but I think it's highly unlikely that we see rate hikes, which are on the kind of schedule that the market has in mind at the minute. I mean, to be clear, we're talking about a rate hike in the second half of 2022 now, 2 rate hikes basically by the very beginning of 2023. And as we said before, that kind of implies that quantitative easing will stop, around about the middle of next year, which just doesn't look likely at all. I mean, I know that there's a lot of uncertainty about inflation, which is overshooting pretty dramatically at the moment, but I think you have to extrapolate pretty aggressively to get to that. And so, yeah, I mean, I think it's overdone. I think it'll be, we'll see some pushback from the ECB. There's an ECB meeting next week. So, yeah.
That was going to be my next question, and I think you could sense it. So the ECB, you think, are going to kind of explicitly push back on rate hike pricing next week?
Yeah, I mean, we've kind of already seen a little bit. There was an online kind of discussion yesterday where Philip Lane, the chief economist, kind of questioned what the market's understanding of what was going on really was here. Yeah, I mean, he's a dove. It's not that surprising, nonetheless. I mean, yeah, it's not like doves and hawks often change their messaging, but when you hear from one side or the other, that's when you have to pay attention. Yeah, I think. Well, I mean, it's the kind of thing that's likely to come up in a Q&A to Lagarde. I mean, she's not going to push back in the statement, obviously, but it's the kind of thing that's likely to come up in the Q&A, and she'll find a gentle way of reminding the market that really they have this new guidance about what has to happen in terms of inflation outcomes. They have to be projecting inflation to arrive at target well in advance of the end of their forecasting horizon, and then to stay there. And very, very few forecasters, and actually, even the market. I mean, if you look at the front end of the inflation-linked market, which has been, pretty volatile as well as you can imagine, and the front end has been leading that, and I mean, it's a market which has been arguably a little bit squeezy as well. I mean, so valuations have really repriced there, but even then, you don't see that. So, I think it's pretty clearly, I would say, gone too far at this stage.
So next week's meeting, then, it's an inter-quarter meeting, which we don't usually get a huge amount from. There's obviously no updated macroeconomic projections. Is there anything else we should be looking for other than a kind of focus on current market pricing for rate hikes and a taper schedule?
Listen, if it wasn't for all the volatility in markets, I think we wouldn't really have all that much to say about the ECB next week, because it is seen as a bit of a placeholder where we're really looking forward to the December meeting as the one where we are going to get the important announcements, most likely around the next steps for quantitative easing when PEP ends at the end of the first quarter next year. I still think we're on that time frame. There are times when the ECB has taken the opportunity presented by a meeting to talk about their displeasure at how volatile the markets are and so on. I don't think we're likely to get that, to be honest with you. Not on the other, whilst Lane was talking about the front end, we had Nott, for example, this week, who is he's a Dutch central bank governor, and he was saying, well, rates probably should, we should be looking at them rising because higher inflation, recovery, all the obvious reasons, to be honest. So although we've had big moves, I don't think they've been so big that the ECB needs to push back on them. And crucially, and this is really important, the move has really been in rates. It hasn't been in sovereign spreads at all. And we look at charts all day long, trying to identify relative value type opportunities. And actually, there's really nothing that's been significantly pushed out of whack there. So that isn't something which I think is going to attract their attention, and it's something which, all else equal, could.
Yeah, I think that's quite an important point, actually, which Mike missed a little bit in all the volatility. So just to round out the ECB discussion then, because we're recording this on Wednesday and the news broke this morning, kind of surprisingly, that Weidmann, the Bundesbank president and very well-known hawk, who's often quite vocal in his hawkish views, will be resigning at the end of the year. There wasn't a huge market reaction to that. He just cited personal reasons for stepping down. Do we think this is a big deal? Does it change the direction of travel of the ECB at all, or is it just one of those things and he'll be replaced like for like, essentially?
Right, so Jens Weidmann, yes, he has been one of the leading hawkish voices at the ECB, and was all through the sovereign crisis and so on. But really, he hasn't been particularly decisive in recent years. I would say he. That's not to say that he had a kind of dovish conversion particularly, but obviously, he is an intelligent person. He can see the challenges that are being faced, and I guess inflation simply didn't really turn out as he perhaps thought it might have done back in 2012, 2013. So I think the likelihood is, just because this is probably the least insightful thing I'll ever say, but he's probably going to be replaced by somebody who's less hawkish. And that's partly because the bar was set so high, within reason, of course. It's too simple to just talk about straight up hawks and doves and people who just block every dovish initiative on principle. That just in practice doesn't really happen. So, but of course, he will be replaced by the new, slightly sort of more dovish leaning, at least kind of by instinct, German sort of government coalition. And so, it's likely that we'll have a more dovish leaning Bundesbank president. Will that make a big difference in the short term? No, I doubt it. But it's something, when push comes to shove in the future, it could make a little bit of a difference.
All right, thank you. Least insightful, I'm not sure about that. I'm going to have to check my records. All right, thank you, Giles. Over to you then, Jan, and well, I guess back to market pricing of rate hikes and central bank reaction functions, as that really is the theme of the week. But, one of the big calls that you guys have had in the US for most of the year, I think, is that whilst we may not need to price Fed hikes sooner, you felt like the market needed to price more Fed hikes once they got going. Obviously, with all this kind of volatility and shifting at the front end, the market has now done that and we have more hikes priced in. Does this change your kind of view, I guess, both on outright duration and the shape of the curve at the front end?
Moves in the front end have definitely dominated, I suppose, kind of like the market, the news flow recently. And since May, we have been pretty much bearish on duration outright, more so on the belly. But we thought, like you said, the market would have to price in more hikes by the Fed, given all this uncertainty around inflation. So we like structures like short 2-year or short 5s, choose 5 stands, belly short. We got out of that trade like a week or two ago, and this week earlier on Monday we exited out of the outright view, just with the idea that, and I'm talking Monday prices now. By the time we're recording, it has recovered somewhat, but in Monday we had something like 50 basis points priced in by the end of next year, 4.5 by the end of 2023, 4.5 hikes priced in by 2023. So not that we don't think market could go further, but at this point, it just seems like any further pricing would be a little bit more challenging. For now, it just seems simple enough, and we prefer to take some chips off the table here and accept that we might see a little bit more of consolidation, which is, I think, what's been happening over the past couple of days. Undoubtedly, some of that has been driven by the UK as well, but we're certainly seeing some consolidation, and that was one of our views. We remain with flatteners, just to make that clear, but we got out of our outright directional views. At this stage now, we see 40 basis points in the market this morning when I checked for end of next year. I can see that going a little bit sideways. However, for the curve view, what you asked, even though a lot is priced in, the narrative of the Fed hiking next year and entering like a hiking cycle in the face of this inflation and inflation certainty and a recovering job market, the narrative will be there. We might not see a lot more pricing, but that narrative should help keep the long end anchored. So, the Fed hiking in the face of supply chain issues, labor issues, energy prices increasing, that could put a little bit worry in the mind of the market as far as growth goes. So we could see a little bit flattening this time, driven by the long end, as opposed to more hike pricing, while the belly of the curve sort of kind of goes more sideways, or even a little bit more consolidates. I mean, into next year, we'll have to probably reevaluate our views again. But at this point, the fives seem at more fair value to us.
So when you're talking about flatness, then are you thinking about 5s, 10s, or even further out the curve, kind of 5s, 30s?
More five stands, but I think I think that 5s, 30s also sounds reasonable. So on balance, I'd say both fit within our framework of kind of long and remaining anchored, and the kind of 5s sticking where they are. So the recommendation we had earlier, man, was the 5 stands, but we added 5s, 30s later to that too, and we're probably going to stick with that for now.
All right, great. Thank you, Jan. I appreciate I've cut you a little bit short this week compared to the other two, but next week is a very exciting week because we're going to talk all things Fed and the refunding announcement. So you will have plenty of time next week to talk about everything. And hopefully the UK might be a little less volatile. So we'll have to spend less time there. All right. Thanks, everyone. I think that really is all we have time for this week. And just a reminder to our listeners, 2 things. First of all, that Bondcast has moved to its own channel. So if you would like to keep getting our latest episodes, then please search Bondcast, the Rates Podcast, wherever you listen to your podcast, and click subscribe so you get our latest episodes. And secondly, if you do have any questions that you would like to ask our Bondcasters, then please send us an email at bondcast@natwest.com. Thanks. Catch up next week.